If we're right that the economy is going to have a harder landing than most economists and strategists expect, what will this administration do to counteract the bad news during an election year?
Today we have the latest interview with ARK CEO Cathie Wood, where she provides an update for the market in 2023. Recent reports suggest that Federal Reserve policymakers are gearing up to increase interest rates this month, with additional hikes later in the year. Officials are exercising caution in declaring victory over persistent inflation, determined not to repeat the 1970s mistake when premature inflation control measures led to a resurgence of double-digit price hikes. The central bank's vigilance is palpable, saying it's too early to claim victory over inflation. Yet, intriguingly, investors are already speculating that the anticipated quarter-point rate hike at the upcoming Fed meeting may signify the culmination of the ongoing credit tightening cycle. This heightened anticipation has propelled both stock and bond prices skyward, underscoring the market's trust in the Fed's commitment. Let's check out the latest interview with Cathie Wood, as she talks about her market outlook for 2023. And what economic indicators we can expect with inflation, the stock market, and the potential impact of cryptocurrencies on the global monetary system. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
Powell's use of the word restrictive and saying that the real interest rate was well above the neutral rate, and that defines restrictive. So half of the solution is understanding the problem. If the economy weakens as much as we think it's going to, the Fed is now getting into the mindset with the use of that word, and we might see a pivot faster than might ordinarily be the case. After all, M2 is down roughly 4%. It has been down on a year-over-year basis for 8 months. What do we have to look forward to? Well, now the topic is potential government shutdown if there's no agreement on the budget. And just like with the debt ceiling, this is going to work out. We're moving into an election year, and no one wants to be seen as disrupting the government and bringing that kind of attention during an election year. So there'll be a lot of saber rattling, but we'll probably land at something in and around September 30th. And then this week we got some clarification. The IRA, the so-called Inflation Reduction Act, which we do not believe that's the reason inflation is going down, but nonetheless. One of the things we are focused on, though, in terms of fiscal policy is if we're right that the economy is going to have a harder landing than most economists and strategists expect, what will this administration do to counteract the bad news during an election year? And I think the bond market is already a bit on the warpath when it comes to fiscal spending. The words "out of control" seem to be bandied about constantly in the press. And I can't imagine there's going to be another layer of spending, but it is a risk. It is a risk. And I think the bond market will not take too kindly to it.
Cathie does believe the current monetary policy, where Chairman Powell refers to it as restrictive, also raises concerns about inflation rates. The potential rise in real interest rates could impact investment decisions in the last part of the year, making investing in alternative assets like Bitcoin and other cryptocurrencies more attractive due to their inflation-resistant properties.
The yield curve is still inverted, roughly 70 basis points, and that's a harbinger of slower than expected or lower than expected inflation, or both. And we think both will be the answer there. And the yield curve has been inverted for a year now. Now, many people are probably sick and tired of this talk about any landing. They're hearing soft landing, hard landing, and most are thinking it's soft landing now. We are thinking harder landing, but how hard? It's certainly not going to be anything like 08, 09. Why? Because we've been in a rolling recession for about a year. As you'll recall, in the first half of 2022, GDP was negative for 2 consecutive quarters. Technically, that's the definition of a recession, but we don't know when the NBER, the National Bureau of Economic Research, is how they're going to characterize this. We won't know for 1 to 3 years, I think, after the fact. But we know that that housing is back down to COVID lows. And we know that autos are still in a very soft spot in the 15 to 16 million unit range. 17 and a half has been normal, 13 in a recession. So it could go down a little bit more. Inventories, we're hearing in this earnings season, big declines in inventories, especially at retail. In some cases, double-digit inventory declines, so 15%. So that's going to hit in the third quarter. Most retailers report through July. So that's interesting. Now, those are some of the most cyclical indicators or cyclical sectors when it comes to economic activity. Capital spending is starting to weaken now as well. But if we have the most cyclical sectors already having experienced some kind of recessionary condition, this landing is not going to be deep. What is it going to depend on? It's really going to depend on the consumer. And in turn, that will probably depend on the unemployment rate. And we'll get to that in a moment. We did get the employment report today. But if the unemployment rate goes up, then consumer spending, we think, given the very low saving rate, 3.5% now, was before COVID around 8%. So it's down to 3.5% now. And the end of the moratorium for student loan payments, which is in September. That could be a double whammy. So consumption is what's going to determine the kind of recession we're in. And I do believe the consumer is on strike also against price increases. We saw and heard a number of companies in earnings season saying, yep, we probably went too far. Even Domino's said it. Probably went too far. We need to readjust pricing. So many people do not believe we will see deflation in the CPI. I believe that's the reason inflation is going down, but nonetheless, we knew that that this administration was going to target drug prices, and we got the 10 drugs. They're associated with large pharma companies, and it was interesting that the stocks actually went up because most of these drugs, if not all of them, are scheduled to go off patent in the not too distant future. And so their prices were going to come down anyway. So while the administration said that the price declines would be somewhere between 20 and 60% for these drugs, and a lot of them are for the highest spending categories that Medicare is trying to control, heart disease especially. Most of the prices, when they go generic, will drop by 80%. That's what usually happens. Now, there will be more drug price cuts, but they're not going to happen until well after the election. So we don't have to worry about it right now. And if the administration were to change, there may be new legislation countering this legislation.
One of Cathie Wood's main focal points this year has also been the movement in crypto legislation in the House, signaling the growing interest in the crypto space. Although crypto legislation might face challenges due to political opposition, she believes that the conversation alone will benefit the crypto market, leading to many growth opportunities in the coming months. What do you think about the latest interview with Cathie Wood and her insights on government debt, rapid economic growth, and the ever-evolving landscape of cryptocurrency? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.